Hello, I'm Juliette Sarli, and this week's edition of IG Macro Intelligence, we take a deep dive into the retail sector amid a challenging macroeconomic environment and amidst expected further rate cuts. Australian retail trade went backwards in April, down 0.1% on the prior month. In the year to April 2025, retail spending was up 3.8%. However, data show Aussies are cutting back on discretionary items due to the cost of living crisis. ABS data show spending on clothing, footwear and personal accessories declined 2.5% in the most recent reading, with spending at department stores falling by a similar amount. And that's translating to a raft of profit warnings from Aussie-listed retailers citing, quote, challenging macroeconomic conditions. KMD Brands, the owner of retailers Rip Curl and Kathmandu, is one of many discretionary retailers who've recently issued profit warnings. The clothing retailer said warmer than expected weather in Australia had hurt sales at its outdoor Kathmandu brand, with total group sales down 0.5% in the first 10 months of the 2025 financial year, compared with expectations of growth of around 2%. Shares have fallen around 33% year to date and are down around 25% over the past 12 months. They hit a record low in both Sydney and Wellington on the back of their trading update, with the retailer also warning it's expecting the uncertainty of US tariffs to hit its full year 25 earnings by around 1 million Kiwi dollars.
It is probably fairly cheap here, but I can't see it turning around really in the next 12 months. And you can be you can be stuck in this thing, for a long period of time. When I think I'd prefer that structural growth story of Temple and Webster, or of the Bunnings and Kmart brands as well.
Well, shares in footwear retailer Accent Group have fallen around 45% year to date. They're down more than 30% over the past 12 months. Accent, which owns a number of brands such as the Athlete's Foot, Style Runner and Platypus, has pointed to challenging trading conditions in the second half of full year 25, with low overall growth in the lifestyle footwear market. Given its recent sell-off, many analysts, though, are bullish on the stock. UBS has a buy rating and a $1.80 price target, and this after it did a recent survey of around 1,000 adults as part of a bid to evaluate spending intentions of Aussies. The survey found consumers are more optimistic about the financial outlook over the next 12 months, leading UBS to upgrade its forecast for consumer discretionary stocks. And UBS is also optimistic on the outlook for Premier Investments, a view that Marcus Bogdan from Blackmore Capital shares.
The other really important thing that we like about Premier, and that supports the dividend, is the fact that they've got net cash of around $250 million and excess franking credits. And so whilst the overall dividend yield is not particularly high, it's around 3.5%, which is what the market is trading at in terms of the dividend yield. We think that with that earnings profile of 10% earnings per share growth through the cycle, that will be matched by dividend growth as well.
Well, shares in Adairs recently had their worst trading day since January 2022 after the furniture retailer issued a downbeat trading update.
This sort of confession season and being sold off as much as they have today, I'd probably be very wary of jumping in. Potentially for some of those value buyers, they might be tempted by the fact that the shares are off 20%, but in a sector where the margins are fairly skinny anyway, and they're already announcing to the market that their margins are declining further, I'd probably be holding off at the moment.
Meanwhile, when it comes to Harvey Norman, analysts more positive. An average buy recommendation and target price of $5.49 according to Refinitiv. That suggests the stock can rally more than 4.5% from where it is. And finally, analysts constructive on the outlook for retailer Myer, which is undergoing a strategy refresh under new CEO Olivia Wirth. The average price target on the stock, 99 cents according to Refinitiv, suggesting it can rise 65% from current levels. Anticipated further rate cuts from the Reserve Bank are tipped to boost consumer confidence and, in turn, retail trade. The risks, though, around US tariff implications and any inflation caused by the escalating tension in the Middle East are the main clouds to that outlook.
When we think about where the risk factors are, it's all about how much consumers actually spend, those nice jumps in income that we've seen. The income's actually back to its pre-COVID trend after quite a drop, although not on a per person basis just yet. So that's a really big factor. But if we don't see things worsen on the global front, then there's every chance we'll see an acceleration in consumption, which will pick up.
And that is your IG macro intelligence for this week. We'll see you next week.